Good evening. As the president of the Atlanta Suburban Alumni Chapter of Delta Sigma Theta Sorority Incorporated, and on behalf of our members, I would like to welcome you to the Managing Student Loan Debt webinar as the final session of our Smart Money Moves series this year. The Atlanta Suburban Alumni Chapter of Delta Sigma Theta Sorority Incorporated, affectionately known as ASAC, is dedicated to providing quality programs and leading the way in social action within our community. Whether you are a recent college graduate or one who has been paying student loans for a few years, we hope there will be information shared tonight that will aid you in decreasing your debt and ultimately increasing your financial wealth. I would like to extend a special thank you for our returning presenter, Ms. Camila Elliott, and thank you all for joining us. Please enjoy the webinar.
Thank you, President Clark. We are very excited that you all have joined us, and we know this will be an informative webinar. Before we begin, we have a few important points to share. First, the media disclaimer. You have entered an area where photography, audio, and video recording may occur. By entering the event premises, you consent to such recording media and its release, publication, exhibition, or reproduction. Second, your mic is muted. Attendee microphones are muted to eliminate background noise for others. And third, we welcome your questions. Please post your questions using the Q&A icon. We look forward to your questions and will answer them during our allotted time for Q&A. At this time, we will have Sharice Reyes with our Economic Justice Matters.
Good evening, everyone. Two things for this social justice, social action moment. If you want to make smart money moves, then you're probably worried about making sure that your children have access to affordable colleges, correct? And you're probably also wanting to make sure that if someone in your family has a medical emergency, that medical debt will not bankrupt them. So would you like to see Medicare expanded in Georgia? And I don't know, maybe if you think that we need as a state to raise the minimum wage so that we can ensure that people working have access to affordable housing, then one thing you need to do is to vote. Tomorrow is the last day of early voting in our elections coming up. And recent data as of yesterday shows that roughly about 27% of registered voters have already cast a vote during early voting. And while that is record turnout for a gubernatorial or a senatorial race and election, it's not enough. We need to get registered voters to the polls. So please, tomorrow is the last day of early voting, or you can vote on Tuesday, November 8th, Election Day. Each and every one of you listening to this need to call, text, email, tweet your friends and your family, because if 27% of people have voted, that means that your neighbor, your cousin, your soror, your niece, your nephew, they have not voted yet. And the lowest percentage of voters are coming from that 18 to 30 age group. Call everyone you know and remind them that if they want to make smart money moves, they need to go and vote for candidates who are going to ensure that their lives are going to be well. Second, as we'll talk about today later in the programming, there was a public service student loan forgiveness program for individuals who made 120 qualifying payments. And it's if you work for a covered employer and if you were a public servant. And we'll get into more specifics about that later. However, there was a waiver that went until the end of October that allowed certain types of payments that previously would not count to count. And there were a lot of public servants who saw hundreds of thousands of dollars in student loans forgiven. Well, the Atlanta Suburban Alumni Chapter of Delta Sigma Theta Sorority Incorporated is asking this administration, we are asking Congress to act to extend that program, extend that waiver so that any and everybody who qualifies has an opportunity to take advantage, because that's how we're going to make smart money moves. So one, sign our petition. The link is in the chat. And then make sure to remind your friends, your family, your sorors, your neighbors, your church members, the Uber drivers, the Instacart drivers, the baristas, any young person you know to vote. Thank you.
Thank you. At this
She
time,
is
our
passionate.
speaker, Carmen Jenkins, our speaker introduction, Carmen Jenkins.
Oh, thank you. Thank you, Sarah. She is very passionate, and we all should be. Thank you. I have the privilege of introducing Camila Elliott tonight to this group. She is the CEO and founder of Collective Wealth Partners, a registered investment advisory firm headquartered here in Atlanta. She has nearly 2 decades of financial planning and investment experience, assisting high net worth individuals, endowments, and foundations, and business owners with comprehensive wealth solutions and holistic planning. Camila spent most of her professional career at Vanguard, working with ultra high net worth individuals and endowments and foundations, inclusive of major universities, hospitals, and other charitable organizations throughout the Southeast US. Her client relationships range from $20 million to $450 million and represented $3 billion in total assets prior to leaving her role. She also worked at Dimensional Fund Advisors, supporting financial advisors with investment solutions to meet the unique needs of their clients. Camila is on the board of directors of the CFP board, which is the Certified Financial Planner Board of Standards Incorporated, setting standards for over 92,000 financial professionals in the US. She is the current chair of the CFP board, the first African-American and one of the youngest ever to serve in the role. She serves on the Investment Committee for Women Against Abuse Incorporated, located in Philadelphia, Pennsylvania, and has been active in volunteering with the IRS Volunteer Income Tax Assistance Program, commonly known as VITA or VITA. Camila obtained her BA and MBA from the Pennsylvania State University. She is a certified financial planner and holds licenses for life, health, and long-term care insurance. I present to you Camila Elliott.
Thank you so much for that wonderful introduction. And it's good to be with all of you this evening. This is a really important topic, talking about managing student loan debt, and going into making money moves and how do we help support our community? How do we help close the racial wealth gap? This is a critical component of that. And the reason why is Black families, 30% of Black families hold student loan debt. So about 1 out of every 3 Black households have student loan debt. When you look at white families, it's 20%, 1 out of every 5. So due to the racial wealth gap, economic disparities, all that, we have more student loan debt. And then also, while we're in college, Black households or Black individuals, we tend to hold 6% more than the initial loan amount when we graduate from college. So the years that we're in school, interest is accruing, and we end up owing 6% than what we originally requested during our freshman, sophomore, junior, senior years. Well, why is this important? Where white households tend to have 10% less in student loan debt. So one, we have a higher propensity to take on student loan debt, much higher than our white counterparts. And then number 2, we tend to have more student loan debt than our white counterparts. And that's why having this conversation about student loan debt is extremely important. So today I'm going to talk about a few things: private versus government student loans, subsidized versus unsubsidized, loan consolidation, loan deferment, how to pay down your student loan debt. And then, of course, the grand finale is the Biden student loan debt relief plan, and we'll talk about the mechanics of that. As we have done with previous sessions, please feel free to drop your questions in the Q&A. We'll be sure that we have enough time at the end to make sure that we can answer your questions thoroughly. So you know who I am, so let's just kind of go right into it. So what are the types of student loans? Well, there's federal and there is private. And there are some key differences. So if you have anyone in your family who's applying for student loans, knowing about this is extremely beneficial. So federal loans, one is that payments are not due until you graduate. You actually get typically a 6-month deferment when you graduate to having to pay back those loans. Federal loans have a fixed interest rate. Just to kind of for your own, the average interest right now for student loans is about 5%. That's the calendar year rate they offer through the federal government. They offer subsidies. So we'll talk a little bit about subsidies, but subsidies really impact the interest rate that you are being, or the interest that you're being charged while you are still matriculating, while you're still in college. Credit check. There is no credit check for federal student loans. The only exception is for plus loans. And plus loans are when the parent requests the loan on behalf of the child. So the parent is the owner of that debt, whereas the child is the beneficiary because they're the one that's actually attending college. Many people may not know this, but there are some tax benefits you have that your interest may be tax deductible. I wish we could have a petition. I talked to Ms. Reyes, we can have a petition here as how do we increase the income limits for being able to deduct your student loan interest. But under current IRS regulation, you can deduct up to $2,500 a year of your student loan interest. However, there are a couple of income limitations. So if you're single, if your income is less than $85,000, you can take that full deduction. And if you're married filing joint, it's $175,000. And the reason why I'm mentioning the ability for more households is that people who tend to have advanced professional degrees tend to have a lot of student loan debt. So they have higher salaries, but they tend to pay a little bit more. And unfortunately, many of those individuals' incomes tend to be too high to get any tax deductibility on student loan interest. But it's $2,500 a year up to that amount. And then consolidation options. So if you have a federal loan, the loan can be consolidated at a later point. Now, the other loan is private. So private loans through private lenders, individual banks. So one of the things that there are some differences. So some are due while you're in school, while some others allow deferment. So what do I mean due while you're in school? So some providers require you to make a payment even while you're still a student, whereas some providers let you have that deferment and you can wait until you graduate to pay that money back. They have a fixed rate or a variable rate. And this is important to know the details, particularly in this rising interest rate environment. Variable rates are not preferred right now. I'm not sure if you all saw yesterday, Jerome Powell, the head of the Fed, just increased interest rates by another 75 basis points. So variable rates can, of course, significantly increase your lending costs, your interest expense costs. And typically fixed rates are preferred. Private loans are not often subsidized, which means that while you're in school, interest is accruing. Private loans do often require, they have a credit check, and they often require a cosigner. And this is really important conversation in the sense that, and many people who end up getting private loans are often those who are getting advanced or professional degrees because they've exhausted a lot of the federal funding. And if you're someone who does not have considerable credit, you spent most of your life as a student, you don't have, high income, your income track record is not strong, you then will have to turn to a family member, a parent, a friend for getting that loan co-signed. I will share with you as a financial advisor, I often discourage people from being co-signers on someone else's debt because that debt is really considered to be yours. And if they don't make that payment, it falls on you. And if you're unable to make that payment on their behalf, it can impact your credit and your ability to have a strong financial foundation. So that's something that it's a big impediment for private loans, is they often do require a cosigner. Interest, again, is maybe tax deductible as long as you meet those income thresholds. And some of these loans can also be consolidated later into a one loan. So what do I mean by subsidized versus unsubsidized? So subsidized loans are determined based upon someone's financial need. So what they do is they look at your income, they look at the size of your household, and they say, you know what, based upon your household, we think that, the Department of Education should cover your student loan interest while you're in college. Unsubsidized loans, they review and say that you do not have or have not demonstrated a financial need. Subsidized loans tend to have lower loan limits compared with unsubsidized. Unsubsidized have higher limits. Who's paying the interest? The education department pays the interest, whereas for unsubsidized, the interest is accruing. Subsidized loans, it applies to undergraduate students only. And then once you go and get a professional degree, most of your loans will at that point be considered unsubsidized. And it's important because when you think about it, particularly, going back to my initial statement, 30% of Black households have student loan debt. And then if that family has an advanced degree, they have a higher propensity to have unsubsidized debt, which means that interest is accruing and it impacts the total amount that they'll end up paying when they're done school. So why do people consolidate loans? And who can consolidate? So both parents and students can consolidate their loans into one. One thing they do is they give you a grace period where you can go and put all of the loans, together in one payment. And why do people do it? One, it's just the simplicity. As a financial advisor, I'll say a lot of my, younger clients, they still have a lot of student loans. And if you aren't familiar with the system, basically each loan is affiliated often with a term or a college. And so, you could graduate in 4 years, but you could have literally like 5 or 6 different loans that you're managing just based on going to, one university. So it can be a lot to manage and understanding all the loan amounts, all of the payment amounts. And, it can be easy for people to fall behind if they don't keep track of each separate loan and make sure they're following the terms and conditions of that loan. So that's why people tend to want to consolidate. Consolidating may lower your payments by extending your term. So if you increase your term, over a 20-year period, you can extend it, which means the monthly payment will be lower, and it gives people a little bit more breathing room every single month. We're at the point now where loan consolidation, you probably will not get a lower interest rate because interest rates are going up. So this is not a play to reduce your interest expense at this point. Consolidating your loan is more of a play to potentially extend your term and be able to pay less every single month by the term extension. And you can consolidate both private and federal loans with a private lender. Again, private loans are a little bit different. They have different types of rules, but you can definitely consolidate federal loans into one lender. So if it's something that you can do you know, if you're someone who doesn't want to manage different loan providers, different payment amounts, things of that nature, and you want to ensure that you're paying your loans on time every single month, loan consolidation could be an avenue for you. But at this point, you need to really be careful at the interest rates. So you want to make sure that you're not creating ease by consolidating a loan, but at the end of the day, have a higher interest expense and could, you know, take you longer to pay because of that. So that's